Good morning, everyone. Thank you for joining us today for a deep dive on state tax insights for consumer brands. Please note that this session is being recorded. If you have any questions, please feel free to drop them in the chat and we will address them following the presentation. This webinar will feature Naturally New York founding partner Anchin. Anchin is a privately owned accounting, tax, and advisory firm that lives and breathes CPG. They work with companies at every stage of growth, from startups to well-established businesses. They have deep experience in areas like transaction advisory, international tax, and even personal wealth preservation, which means that their clients never really outgrow them. Anchin's clientele includes companies in all aspects of the CPG industry, from brands and their investors to distributors and retailers, so they have a comprehensive understanding of how the whole community works together. It is my absolute pleasure to introduce Alan Goldenberg, a tax principal who leads Anchin's state and local tax and tax controversy groups.
Thanks, Ashley. Morning, everyone. Good afternoon. Thank you for having me. I see we have a nice intimate group here, so feel free to, make it interactive. Ask any questions. Not making anyone come on camera, but feel free to kind of make this a little more participatory. You don't have to listen to me for the entire time. But today we're going to be discussing a very important topic when it comes to state and local tax, and that specifically is the concept of nexus. It's a very deceptive, simple word, but in the world of taxes, it carries a tremendous amount of weight. And it really dictates whether a state can make a business file tax returns, collect sales tax, pay tax, subject the owners of the business to audits or to penalties in that state. And in today's environment with remote workers, e-commerce, marketplace facilitators, nexus questions come up more frequently than ever. So our goal today is kind of take a clear look at how nexus is defined, how it's evolved, and what businesses, particularly those in the food and beverage industry, need to be aware of to stay compliant and to manage their risk. So just before we begin, here's our legal disclaimer. Bottom line is, if you have any specific questions, please contact us outside of this webinar for a more formal engagement. All right, so let's start with the basics here, and as we jump right in. So nexus is established when a business has a sufficient connection with the state that basically allows the state to impose its taxes upon that business or that taxpayer. So a state really can't just decide, like, out of nowhere, hey, I'm going to tax this business. It owes tax to Idaho. There has to be a meaningful connection, or what we call in the tax world, nexus between the business and that jurisdiction. The concept is ultimately rooted in the U.S. Constitution, which ensures that states can only impose tax when there's a fair link with the taxpayer. So that the amount of that contact can vary depending on the types of taxes. So for example, what establishes nexus for sales tax may be very different for what establishes nexus for income tax purposes. And even when nexus is established, there are limitations out there, such as Public Law 86272, which may protect businesses from income tax obligations. So we'll get into some of these concepts and their application as we go through this presentation. So traditionally, states have looked for certain physical contacts to establish nexus. So if a business has an office in a state, that's nexus. If you have property in a state, if you have inventory in a state, that's nexus. If you have employees physically working in a state, even remote employees, again, that's nexus. So further, states also consider whether there's a continuous or systemic or regular contact with that state. What is that connection? What is that link? States also sometimes have this very broad catch-all category of doing business in a state, which is why sometimes making nexus determinations can be very complex. So let's start with a little bit of history so we kind of build through this and kind of get an appreciation of where we are today. And that kind of the beginning of the conversation really starts with the Quill case, Quill versus North Dakota, which really was the cornerstone for state nexus laws. And here's the background. Quill was an office supply company based in Illinois. North Dakota wanted Quill to collect sales tax on products that is sold to customers in the state. The catch was that Quill didn't have any physical presence in North Dakota. It sold through catalogs to customers, and orders were shipped from outside of the state. The case went to the U.S. Supreme Court, and the court ruled that a business had to have some sort of physical in-state presence before North Dakota was able to enforce its sales tax obligations on Quill. In other words, just simply mailing goods and catalogs from out of the state into North Dakota was not enough to establish nexus. So from about the early 80s when this case was decided until only a few years ago, physical presence was the standard. You needed to have that in-state physical presence, like we talked about, be it property, be it inventory, be it employees in that state, in order to have nexus, so that a state would be able to obligate the company to have to collect sales tax or pay income tax. Over time, Quill got interpreted different ways, and states obviously tried to limit the scope or application of physical presence in order to be able to tax these out-of-state businesses more. What happened, as I'm sure you're all aware, is that we sort of moved away from this brick and mortar, sales model, and it became more online based. And because of that, a lot of these physical presence rules really came into question. So let's fast forward to 2018, the famous case of South Dakota versus Wayfair, and this really reshaped the Nexus landscape. South Dakota enacted a law saying that sellers with no physical presence in the state would have to collect and remit sales tax if they crossed a certain threshold. In this case, it was a seller having over $100,000 of sales of goods into South Dakota, or 200 separate transactions throughout the year. If you met either one of those thresholds, that out-of-state business would be subject to South Dakota sales tax. The case was challenged and went to the U.S. Supreme Court, and the Supreme Court agreed with South Dakota and said, basically, the way the economy is now, the physical presence standards are really unworkable. With the growth of e-commerce, a business could be doing millions of dollars of sales in a state without ever having set foot in that state, and yet still not be subject to tax under the old physical presence standard. So with this, the court held that economic presence was enough to establish substantial nexus in a state, right? The court did not rule that the $100,000 threshold or the 200 transaction threshold was in fact a requirement, but just in general, that a state could impose an economic nexus rule. So what does this now mean? So in the wake of this ruling, all 45 sales tax states and the District of Columbia have now adopted some form of economic nexus for remote sellers. Okay, most states do mirror the thresholds that South Dakota started, the $100,000 of sales, but some states even have an increased threshold. New York, for example, and California have higher thresholds up to 500,000. The volume transaction test, which South Dakota had the 200 transactions, a lot of states implemented that initially. However, they've sort of moved away from that and repealed that aspect of the law because it became a very difficult way of defining what exactly counts as a separate transaction. Is it separate goods? Is it separate contracts? So that sort of concept has fallen by the wayside, but the sales threshold is still in force. So the bottom line now is if you're selling goods to a state, even without an employee, without an office, without property, once you cross that threshold, you likely have nexus and an obligation to collect and remit sales tax. Okay. So as Wayfair sort of expanded, states realized that it became difficult to enforce sales tax collections from a lot of small, third-party retailers that were operating on, the various marketplace websites. Think Amazon, think Walmart, So if you sell through one of those platforms, right, not as an individual seller, what the states did is they shifted the burden and they said, you know what, we're going to have these marketplace, providers collect and remit sales tax. So this simplified the compliance for both states and the sellers, right? From the state's perspective, it was much easier now to collect from a handful of large marketplaces rather than just the, thousands of little independent sellers that may be out there. And from a seller's perspective, it worked out well because it means one less filing. You don't have to worry about it if you are if you are selling on these, platforms. Okay, so what does this all mean now for those in the food and beverage space? So now, because we're talking, national New York here, um, we need to understand how these rules all apply. So for sales tax laws, um, it's important to remember that when it comes to food products, right, there's usually some distinguishment that's done among the states between standard grocery items and ready-to-eat food. By and large, grocery items like packaged and canned food, think fresh meat, produce, dairy items, baked, baking ingredients, things like that, those are usually exempt from sales tax. But ready-to-eat food, heated food, food sold, on a premise for consumption at a restaurant, for example, candy, soft drinks, and sometimes even dietary supplements, these can be taxable in many states. Sometimes at the full rate of tax, and sometimes states have a lower or a reduced rate of tax on these items. So for companies in the food and beverage space, you have to understand whether your products are taxable for sales tax. And if they are, you got to really monitor, right, your level of sales in these particular states. Are you crossing a threshold in a particular state such that a sales tax obligation may be triggered? Perhaps you are selling on an online marketplace. Well, that will remove the burden, right, and the compliance responsibility and shift it to the online marketplace. Nevertheless, you do want to track those sales because oftentimes the online marketplace sales and your direct-to-consumer sales, perhaps through your website, will be combined to determine whether you've hit that, threshold sales figure. So important to really keep track and keep monitoring this. Another area that we often see coming up in the sales tax realm for food and beverage companies is at trade shows. Some states provide physical presence exceptions for those businesses attending a trade show, so you don't automatically trigger Nexus, right? So, for example, states may cap the number of days you can be in a state because of a trade show, right? Or limit the volume of sales that you engage in at a trade show. So despite the fact that you have physical presence, you're actually at the trade show. Nevertheless, there are exclusions or exemptions to at least be able to avoid that potential nexus. But there is something else to keep in mind, and that is product samples. We're used to that at every trade show. We love to give out items here. Try our food. And if you do that, and if you're withdrawing products from your inventory, right, those may be subject to sales tax, or in this case, use tax, because you wouldn't have paid sales tax originally, if you purchase them tax-free. So if your products are taxable, if the food items that you're selling, maybe candy, maybe it's a soft drink, maybe it's a dietary supplement, and you're giving out product samples of that, that could very much trigger a use tax obligation in these states where you're having trade shows. Okay, let's shift gears a little bit because we're talking a bunch about sales tax. And now let's talk about income tax and how this whole wafer thing kind of bled into this. So it's important to understand that for income tax, we'll be talking about not just straight net income tax, we'll also be talking about franchise taxes and excise taxes. A lot of times these taxes are essentially gross receipts taxes. For those of you who may have sales into Washington State, you may be familiar with the business and occupation tax or the Texas franchise tax. So essentially what happened is that states realized that this wafer decision was a really great thing. And they didn't stop applying its concept and its rules with sales tax. They began employing it also in the income tax world. So today, over a dozen states assert that if a company has significant sales into a state, that alone could create income tax nexus, even without a physical presence. So some states use a bright line threshold test of 500,000 or say $1 million of sales for income tax purposes. These are maybe different than those for sales tax. And then other states also started employing some de minimis rules when it came to to property and payroll, usually about 500,000, or they will assert economic nexus if more than 25% of sales, property, or payroll of a business is located in that state. The concept being is that if you have enough of an economic benefit received from the activities being performed or sales occurring in those states, that state wants to tax you. They say you are subject. So I don't care if you are based in New York and you are selling, into Arizona and you have no physical presence. If your sales exceed 500,000 or $1 million, let's say, Arizona, could take the position and say, you've benefited enough from the residents of our state, we're taxing you. You're going to be subject to Arizona income tax. Not every state has a threshold. As I said, only 12. It's a lot less than the sales tax, but we are seeing it grow more and more. Each year, we're seeing one or two states being added to the list. Most recent one was Maine. So if you're doing over $100,000 of sales in Maine, you should be wary that you may have income tax nexus there. And the last bullet point here about 86272, we're going to jump in at the very end because that might actually provide some level of protection. Okay, so a few notes of caution about sales thresholds and economic nexus. So some states apply annual inflation adjustments, so meaning that the actual dollar amount can change year to year. It does vary. In some cases, these rules only apply to corporations and not to partnerships. So there are states, New York being one of them, where if you have sales into New York of over about $1.1 million, it really depends on whether you're a corporation or partnership. Corporations are subject to economic nexus rules in New York, but not partnerships. And as I said it kind of before, the thresholds oftentimes are different than sales tax. So you can be filing sales tax returns in a state because you've crossed the economic nexus threshold, you've reached that, but you may not have reached the income tax threshold, and therefore you're not filing an income tax return in those states, and that's fine. And that's a very normal way of businesses operating. And finally, physical presence rules still apply. So if your inventory is located in a 3PL in California, let's say, just having that merchandise in the state of California is physical presence that will create nexus. We don't even have to look at your level of sales in the state to determine whether you have income or sales tax nexus. That physical presence is still a standard that's out there and available and should be thought of just strategically, right? So when you're planning about where you want to put inventory, yes, there are costs to storing inventory, but understanding that opens you up for compliance as well as potential tax risk in a state. Maybe that's a thought of where we want to move that inventory. Do we want to put it into a state that may be a little more taxpayer friendly? Okay, so I mentioned this a couple times already, and I think this is really important concept um, for the food industry, and that is Public Law 86272. And the reason that it's important um, is that it's a federal law, which trumps state law, and it basically says that a state can't impose a net income tax on a business if all they do in a state is solicit sales of goods, of property. So for this protection to apply, right, you have to have orders that are approved from outside the state, and you're shipping the product in via common carrier from elsewhere, from another area in the state. So for those of you who have sales reps that are traveling around the country, meeting with retailers, that is solicitation of sales. So that does not necessarily create nexus because of Public Law 86272. If that's all you're doing is soliciting sales from a customer in a state, you then send that order back to home base, to the headquarters for approval, which is in a different state, and your goods are shipped from that other state, from outside the state, you are protected if that state has a net income tax. So to just put it into more practical terms, we are a New York-based business. We have sales reps that travel the country. Our inventory is stored in California. We meet with a retailer in Colorado that wants to purchase some of our products that we that we sell. Um, they put the order in. That order will then get approved via the New York office, and we'll ship the goods then from California into Colorado. Colorado has a net income tax, right? Colorado also has an economic nexus standard um, of $500,000 of sales. Even if you were to ship $1 million worth of product into Colorado, because all you did was solicit sales in Colorado, Public Law 86272 bars the state of Colorado from imposing a net income tax on that New York-based business. So, the key with Public Law 86272 is really understanding what activities, what can be done, and where it applies. So it protects many activities related to solicitation and those activities that are ancillary to it. So think advertising, think carrying samples, display racks. If you have a temporary showroom, right, as part of maybe your a trade show that you're doing. If you're recruiting employees, perhaps, or training sales staff, right? Those usually are still under the umbrella of solicitation of sales, and you didn't violate or go past the parameters of 86272, right? But what are some things that are not protected? If you collect payments, if the customer in Colorado wrote you out a check and you took that check from them, that's crossing the line. If you have consigned stock in a state, right? So you go out to the grocery store, I'm going to put all my goods, on consignment in your store, whatever you sell, we get a percentage back of. No, no, no. You still own that product, that inventory in the state. That gives you physical presence. You no longer have, you're no longer soliciting, and you would have nexus and be subject to income tax. So you really need to be careful in terms of what are your employees or your sales reps doing in those states, right? If they cross the line and they engage in unprotected activities, you'll end up losing the 86272 immunity, and that will give you income tax exposure. Okay. So let's keep going here. So here what I did, and I think you're going to get these slides afterwards, or they'll be posted. But here I wanted to provide you a list of some of the items that I just kind of mentioned as to where you're safe, where you're protected, and where you're not safe, where you're not protected. So again, think about it this way. States want to limit the scope of 86272 as much as possible. They don't like it because it prevents them from imposing tax on out-of-state taxpayers, which they love to do, because out-of-state taxpayers, for example, you know, don't don't vote on the local politicians, so they're thrilled to export the tax burden right to those outside. So they are always looking for ways to trip up out-of-state businesses, so you kind of blow that protection. Unfortunately, there are no regulations that have ever been issued on 86272. So the states have felt like over the years they have free rein in terms of how they will interpret it and how they want to apply it to many businesses. So we are seeing many states get very aggressive when it comes to limitations on 86272. New York, New Jersey, and California being the primary examples of those. They've recently issued guidance saying that if you engage in some sort of business activities, those can exceed 86272. And what do I mean by that? If you have post-sale interactions with customers, maybe there's an online chat on your website. We've all seen software companies, and I know it's not exactly this group, but if you've seen a software company, I can't figure out how to use this software. I'm going to go online, somebody will remote into my computer and show me how this item works, or get the plugin to work correctly on my computer. Well, California, New York, New Jersey, they're saying, well, you're no longer just soliciting sales. You're doing something else that's beyond 86272. And because of that, you no longer have our protection. So if I'm a remote business and I'm selling into New York, New Jersey, California, I could lose the immunity. In the food and beverage space, Maybe if by going on your website, you're entering cookies, for advertising purposes on a customer's website. Maybe you have an online chat where I'm putting out a product and I want to get feedback, from somebody, or I don't know how to use this baking good, here, oh, we have chefs online that could give you an idea and we can, chat with you. I don't know if you have that or not, but perhaps you do. If that's happening, these states could say, you know what? You've lost immunity. Um, despite not having physical presence, we're going to make you subject to income tax and sales tax, right? And by the way, this really doesn't matter whether you're a wholesaler or selling direct to consumer. The concept, unlike sales tax, which is usually only applied on the last sale, this concept of 86-272 and economic nexus for income tax purposes applies to both wholesaler and retailers. This is rapidly changing. There's a lot of discussion in this area. So this is kind of an area that we really, really watch closely for all of our consumer product companies. So just some very, very quick final points on 86-272 because we're in the deep weeds of state and local tax. First and foremost, if you have sales to foreign countries, those generally are not protected under 86-272. That's a separate analysis, permanent establishment, tax treaties, etc. 86-272 is a U.S. tax concept. And in addition, you may be aware of this concept called a throwback rule. This is something that we see in big states like California, where if you have product inventory in a state and you're shipping them to customers in other states, but you may not be subject to those tax in those other states because you have 86-272 protection, those states, they get thrown back. California thrives off of this as an example. So many goods and so many items are in 3PLs in California that as long as a business has title to them, they own them, and they're selling to all these various states, they may not be taxable because of the immunity. But California says, that's okay. We'll tax them. We're happy to take the tax revenue here. So something that's really important, there are planning and strategizing opportunities to reduce that burden. It's something we can absolutely discuss if you find your business being sucked into California under the throwback rule. So to close out the presentation here, and I see we have a couple of questions, which I'll get to in a second. Let's just wrap up with talking about some practical guidance on due diligence, preparing for transactions with investors, managing nexus, right? Mitigating the risks, that sort of thing. So first and foremost, companies really need to be proactive about their nexus, right? If you're registered for sales tax in a state, you got to think about whether you have an income tax obligation or not. Doesn't always go hand in hand. Sometimes they do. We know standards could be different. And we know 86-272 can play into the equation. But nevertheless, if you are registered for a tax, sales tax, payroll tax, income tax, you are on a state's radar screen, right? Even we've seen Secretary of State registrations. If that's something that maybe you have, that is something else. Again, the more information that the state has at their disposal, the greater risk there is that you could get a tax notice or a questionnaire from a state. With that also, it's really important to look at your apportionment formulas. How are you dividing up the income among these states? Remember, some states use just only a sales factor. Some states use, an equally weighted three-factor formula. They look at your sales, your property, and payroll in that state to evaluate your tax. So, in those three-factor states, you may be able to reduce your tax burden, even though perhaps you have economic nexus because you've sold so much into the state, right? Because depending on how the apportionment factors work, you may be able to dilute the factor a bit because states may have other considerations that you may not have in that particular taxing state. If you're preparing for a transaction or looking to bring on investors, Nexus is probably one of the first things that they'll be looking at to scrutinize, right? Under due diligence, it's very easy. you need to verify all the tax filings, income, sales tax, payroll taxes, excise taxes, you name it. These are all easy to spot. They're easy to review. They will be on every questionnaire that will come across your desk. You got to pay special attention um, to the jurisdictions you have activity in, but may not be registered or filing it, right? This is, again, because of Wayfair, this all of a sudden became a bigger, right, issue. And this is what they're looking for when they're reviewing your books and records and your filings. I see that you have X amount of sales in the state. I see that you hired a remote employee. I see your payroll is here. I see that you have inventory, but you're not filing tax returns in those states, or you're not filing sales tax returns in the states. Why? Right? So you have to be able to address those. Um, you want to assess what the materiality of that exposure is, right? What does that noncompliance really result in? And then create a plan, address it for going forward, right? Be proactive um, in dealing with these and spotting the issues, right? Your investors, they're going to want assurance that there is no hidden liabilities, somewhere that could transfer to them. Payroll is a fiduciary tax, meaning that the investors of a business could be subject to personal liability on those taxes. So they're going to really want to make sure that they're protected and that you as a business are in compliance. So how do we manage Nexus? Listen, this is not a one-time thing. It's not a one-time project. It's an ongoing analysis. It's ongoing attention is needed, right? You got to regularly review your Nexus footprint, right? Especially if you're hiring new workers, if you're getting new office space, leasing new locations, even shared office space, WeWork office space, right? Look at where your inventory is. Is it on consignment? Where is it stored? Is it in 3PL, right? You have a co-packer, or something of that nature. Do you own that product, with the co-packer? Do you not? Right? These are all sort of questions I think that need to be discussed and really analyzed. It also means that you have to constantly be in communication with the various aspects of your business, right? Your operations, your HR, your tax department, and even us or whoever your accountants are, right? Really tracking these changes. Did something significant happen? Hey, I'm thinking about moving my product, my inventory, here. Or we really think that this individual could be a great addition to our team. Oh, but by the way, they live in New Mexico. What does that mean? So regular reviewing your nexus with your advisors can really, really make sure that you're not missing any obligations in these states. Finally, you want to look at your internal systems, your internal accounting systems. Make sure they're capturing this data. Make sure you're recording where your sales are going. Make sure your payroll company knows where your employees are located. So remember, bad data in is bad data out. So the better the information you have on hand, the easier it is to address any concerns. Okay, so now what happens? We did this analysis. You reach out to Anchin. I hired this employee. Uh-oh, I discovered now that I have Nexus, but you know what? We never filed. Okay, we can deal with it. There are several tools that are available. First and foremost, almost all states have voluntary disclosure agreements, which is a great tool. It allows you to voluntarily come forward, reach out to the state before they get you, um, and basically limit the look back. Usually it's 3 or 4 years. I can file going back that, short period of time, pay the back taxes, pay whatever interest is owed, and that's it. Penalties abated, and we don't look back. We just, be compliant going forward. Every so often, you'll have other states will come out with amnesty programs, and these sometimes are even better than voluntary disclosure because they'll waive interest too sometimes. Again, same idea. File if I'm not under audit, clean up whatever happened previously, and let's just move forward. I think the key is you got to approach the state before they get to you. So being proactive and just being more upfront about it. Is helpful because if they send you a notice, if they send you a questionnaire, right, before you reach out to them for voluntary disclosure, you become ineligible to for the program, and then they can go back to the beginning of time when you establish Nexus. So that's why if you do get a notice, if you do get a questionnaire, it's very important on how you respond to those and how you address those, right? Now we know voluntary disclosure is not an option. But how is it that you respond, right? Do you want to write down that you hired that employee, going back to, 2016? Well, wait a minute. Maybe that employee was only a sales rep, right? Maybe I have 86272 protection. So there's a better way of answering and responding. So the state doesn't think that I owe them, back taxes, for the last decade. Um, Again, I think one final point here is that don't ignore any letters or notices um, that come in, and don't ignore any exposure or potential nexus that you have. If these come across your desk, if you realize them, the sooner you can address them, the faster you can identify what the exposure, what the risk is, and a much better outcome is likely. So finally, I just want to make a little pitch here for Anchin. We're here. We're available. This is what our team does in the state and local tax group. We provide this guidance. We help you reviewing your existing Nexus footprint. We'll evaluate what the business implications are for any future Nexus or any potential changes to your business, or for that matter, any investors that you have coming on. We'll assess the products and services they are offering. Are they subject to sales tax? Are they not subject to sales tax? Do you have some protection? Are there exemptions? Are there certificates that we should be on the lookout for? We can talk about technology solutions to help better manage your business and your Nexus requirements, right? We can help registrations. I'm trying to think what else. Obviously, any filings and support you with any audits. So the bottom line is that Nexus is really complicated. And it's detailed and it's nuanced, and you have all 50 states with so many different rules. But at the end of the day, if you have a systematic and proactive approach, it is manageable. It can be dealt with, and the burden then is really reduced from the outset. So with that, I thank you for your time. And I know it was quite a heavy lift on state and local tax, but I appreciate it. And I'm just gonna see if there are any questions that popped up. I'm happy to answer any that you put in the chat. If you want to come off of mute or enter any more, please feel free. So here, this one is from Joel. Does Coman create nexus if inventory is moved to 3PL in different state? Yeah, it can. And really the detail there is, again, ownership and title to the goods. So it absolutely can. If you have title to property that is inventory in a potential state that you have, that would give physical presence nexus. So I think it's kind of looking at your contracts, understanding where it is that you take title to the goods, where they're yours, and then based upon that, determining the nexus responsibilities. Okay. Joel, did that answer your question? Oh,
Yeah, I did have
yeah.
a follow-up,
Okay.
Alan.
Yeah.
You can hear me. This is sort of on a different. Thank you for that. So it speaks to the importance of the co-man agreement. If you're in a, trying to manage a high tax situation. The second question, is sort of unrelated, is it correct to say that if you have LLC members, meaning investors, that does not create nexus, since they're generally in an operating agreement, they're not employees, they're LLC members?
That usually is correct. So correct. That doesn't necessarily create nexus. So if they're operating, if you have an LLC investor, if you're in New York and your LLC investor is based in California, that does not mean that you as an operating business have nexus with California. Um, there are some states that when it comes to income tax filings, if you have a resident partner of that state, you do have to file a tax return to that state. That doesn't necessarily mean, though, that you have income apportioned or sourced to that state. So New York is a primary example of that. If you guys are based in New Jersey, but it just so happens that one of your investors is from New York requires you to file a tax return. It's a zero return, let's just say, because you don't have nexus there per se, but there is a compliance obligation that could happen. So just be aware of that.
Great. Thank you. Thank you, Alan. This was great.
Okay.
Thank you.
Okay. Anybody else? My contact information is here, so really feel free to reach out at any time with any questions, be it now or down the road. Again, we're always happy to speak and provide some guidance as needed. Okay. So
Thank you
I
for joining
think
us today. Naturally, New York is committed to providing value to the New York CPG community. Head over to their website, naturallynewyork.org, to explore other events and additional resources. Thank you, everyone.